Can you actually make money from trading? What's all the hype about? In this video, you are going to learn whether or not you can actually make money from trading. Hello and welcome to the Pine Street Capital YouTube channel, where we talk all things trading and investing. My name is Ron Muchaka and I'm the managing partner of Pine Street Capital. I've been trading for over 6 years, and today we are going to be talking about the all-important question of can you actually make money from trading? If you haven't already watched the part 1 within the Introduction to Trading mini course, then I'm going to link it right over here. And you can watch that so that you have more context whilst watching this part 2, where we cover can you actually make money from trading. If you remember the previous one, I actually ended it on a very gloomy note in pointing out that an academic study was done on traders, about 19,000 of them, and found that 99.52% of them actually failed, right? So what are we actually doing here? Why are we wasting our time on an industry whereby only 0.48% of people actually make money? That's what we're going to cover within this video.
Welcome to the second video in the Introduction to Trading mini course. In this video, we're going to cover the all-important question, can you actually make money trading? By the end of this video, you should understand the retail trading side of the industry. You should also understand the professional side and learn what the differences between the two are and what the chances of success are on either side. Now, just to recap what the actual statistics are. In the last video, we talked about the 90-90-90 principle, which states that 90% of retail traders lose 90% of their money within 90 days. We also revealed that the typical retail trader has a 0.24% chance of making any money. Now, based on the information I've given you so far, would you say the typical retail trader actually stands a chance? Well, short answer is yes, but the typical retail trader is highly unlikely to succeed. The long answer is that I haven't told you the whole story. So here it is. There are 5 types of retail traders, and I'm going to break down each of them for you. So the first one is what I call type 1. And this is the instant gratification guy. What you'll find is these traders are very naive. They have no idea how difficult it is to make money in the markets, and they do zero homework. They have a short attention span when you present them with the real information that you need to make money. Information like this, they wouldn't get through the entire training. They believe in fantasy returns, usually blow their small trading accounts within a few weeks. They blame everyone else for their failure and say things like Forex is a scam, or Forex doesn't work, or trading doesn't work, things like that. And you can already see by the personality type that this person is highly unlikely to succeed. And they're very similar to the second type, but the second type has more persistence, so to say. And the second type is called the reloader. This is the broker's favorite type of client because the moment he blows his account, he then reloads his account with more money. He shares very similar traits to the type 1 trader, except he reloads his account whenever he blows it. Usually uses terrible strategies that he's learned off free YouTube videos, and always looks for free strategies, free signals, free training. And what they get out of this free information that they're seeking out most of the time is manifested in the types of conversations that you end up having with them. They usually ask questions like, what's the best Fibonacci level to use? What's the best indicator? What's the best strategy? And they don't let go of fantasy returns until they eventually exit the game. And the reason why they hold on to the idea of fantasy returns for so long is because some of the strategies that they would have tried have met their expectations in the short run, but eventually they find out that these strategies don't work the hard way. This then leads to a vicious cycle of strategy hopping and they do this over and over and over again until eventually they're tired or they run out of money. The next type of trader is the type 3 trader, who wants to be a full-time trader but runs out of money. They're a lot more serious about trading and a lot better capitalized. What you usually find with the type 3 trader is that they usually got into trading after inheriting some money, which usually gives them the base they need to last longer in the markets than they otherwise would have been able to. Now, they usually pay for expensive training, signals, or newsletters. There are actually quite a few cases of these types of guys running into the hundreds of thousands or millions of dollars in losses from trading. Once they get into a very vicious cycle of losing, they tend to do stupid things like get into debt whilst trying to make money trading by taking out loans from the bank and borrowing from friends and family, when instead they should have put in the time to seeking out proper information rather than gambling away their money and borrowed money too. They usually don't have sufficient skills or experience and usually just run out of money. The next type of trader is the type 4 trader. This is the wise guy who walks away after experimenting. They're usually from a business background, so they understand how hard it is to make money, which gives them a healthy amount of skepticism. They usually have a constant stream of cash flow to sustain trading from a job or a business that they run. A lot of them are self-employed. They do a bit of research online and might get into things like copy trading. If you tell them something that sounds too good to be true, they'll smell a rat and most likely walk away without losing too much money. If they do try it and make money, they'll stick with it, take the reasonable steps to protect themselves and their capital. But if they don't make money, they'll rush for the exits. Now, the last type of trader is the survivor with potential for long-term success. And these are very rare, extremely rare. They put in the long hours over many years with narrow escapes, but have honed their skills. They've reduced their leverage and expectations to realistic levels. Well, that's usually after they've made a huge amount of money using high leverage, which isn't sustainable, and they realize this. That's for the ones who are lucky enough to realize it. Long-term success is never guaranteed because the markets are in a constant state of flux, and what works today won't work tomorrow.
The good thing is that they realize this, and the biggest factor that might play into their long-term success is grit and persistence at the end of the day. Now, let's compare the chances of success of each trader on a scale. Now, chances of success for the type 1 trader are 0.24%, and that's the type of trader who we talked about in the statistics from the study. Now, the type 2 trader, because they have a bit more persistence, have a greater chance of success, but not that much higher. Now, the type 3 trader has a significantly higher chance of success because of the fact that they usually have a lot more money on the line, and you know what they say. The moment you write a check, you're motivated to perform. This is why they have a 1.8% chance of success. The type 4 trader probably has the most desirable characteristics, but the only problem is that there is no persistence and they don't really have the desire to succeed that the type 5 trader has, and that's the retail trader who has a 3% chance of success. Now, what you need to understand about the scale is that these aren't just numbers that I got out of my head. These are numbers based on academic studies on traders of different skill levels. So if you are serious about trading, then you should take these numbers seriously. And it should be evident to you right now that if you want to be a type 1 or type 2 trader are so close to zero that you probably shouldn't even try unless if you're hoping for luck to bring you to the point where you're a successful trader. If that's the case, then by all means, go ahead. So if those are the chances of success for a retail trader, what are the chances of success for a professional trader? This might surprise you, but not all professional traders actually make money. In fact, the majority of them actually don't. The study was done on proprietary traders at a firm in New York City, and if you don't know, proprietary traders are basically the professional traders you see with the multi-screen setups on TV or online or wherever. And what that study found was that only 20% of them were able to make money over a 2-year period. And this was during a time when the market was really volatile, which presented a lot of opportunities for them. And what it really tells you is that even people who have gotten a lot of training still have a hard time making money in the markets. But when you compare it to the chances that a retail trader has of making money, you might actually want to be in a position to have a 20% chance of making money. In the previous slide, we looked at the chances of success for retail traders, and this was the comparison that we saw on the scale. Now, when you include professional traders in that scale, when you look at that, look at the huge gap between even the type 5 trader who has the highest chance of success and the professional trader. The professional trader is 6.67 times more likely to make money than the type 5 trader, who's the trader most likely to succeed in the long run. When you compare the professional trader to the type 1 trader, the professional trader is 100 times more likely to make money than the type 1 trader. That is a huge gap. 100 times more likely to make money than the type 1 trader. Now, the reason for this gap is simply because traders have less education and they spend less time learning. They also open accounts with small amounts of money, like $100, $50, and that just doesn't drive them to get the results as much as the professional trader would. And on top of that, they spend less on education, so they're exposed to lower quality material. And the final reason for the gap is the dark side of the industry. The truth is, a lot of retail traders end up falling prey to a lot of these scams. They deposit money with fake brokers. They give their money to account managers who then disappear the next day. Well, there are 3 main reasons why this happens. The first is because they just don't know any better. And because they don't know any better, this triggers emotional responses rather than logical ones. When, for a lack of a better phrase, shit hits the fan. It's no longer the unsystematic reflective part of the brain making the decisions. It's the systematic part that doesn't give a second thought to your actions. Because of the fact that money is involved, the emotions are heightened, and so are the effects of the stupid decisions that they end up making at this point. I mean, what you will notice after a few of these death spirals is you end up taking bigger and bigger risks to try and make back all that money that you lost from the first day that you heard about trading. The moment you get emotional about money is the moment you're most vulnerable to people within the industry looking to take advantage of you. And the worst thing is you'd never suspect any of them of doing this. And they then use this to exploit you, because what retail traders usually experience is what's called the dunning-kruger effect, which is illustrated in the graph on your screen now.
The dunning-kruger effect is a cognitive bias which makes people assess their cognitive ability as greater than it actually is. To simplify that, it's a flawed way of thinking that you're better than you actually are at something that you are fairly inexperienced in. And what this graph depicts is the level of competence measured against the level of confidence. So when you're starting out, you are very confident that you can do something as you learn a little bit. You learn about some indicators, you learn about candlestick patterns and stuff like that. And you keep going up that confidence slope. And what they usually call that is the peak of Mount Stupid, when you believe you can do it, and eventually you put your money into your trading account and then you start losing money, so you start to slide down the slope, and you're then like, okay, maybe I'm not as smart as I thought I was. Then you go down, and when you're near the bottom, you start to ask yourself questions like, can I really do this? Can I really be successful in trading? And once you get to that point, you start to seek out more information, better quality information. That's if you stick with it. You seek out better quality information, you start consuming it, and slowly you start to build up your confidence, and your level of competence starts to rise. And that's when you start getting onto the slope of enlightenment, whereby you realize that you didn't know as much as you thought you did, and now you're realizing that, and you start to feed yourself good information. And when you eventually reach a level whereby you actually are competent and you know it, that's where the plateau of sustainability is, and it's just a flat line from there. So an alternative that you might have seen to this whole thing is when you're starting out, you're at a level of conscious incompetence. That's when you're at the bottom of the graph, like right where it begins. Then you reach a level of unconscious incompetence, which is the top of Mount Stupid. Then you go down to a level of conscious incompetence, which is the value of despair. Then you start to rise, and you reach a level of unconscious competence. So you're not aware that you can actually do this now, which is somewhere along the slope of enlightenment. Then conscious competence is sort of where the plateau of sustainability is. The facts of the situation are that most people are somewhere near Mount Stupid, and that might not necessarily be you. But for the sake of people who are at that level whereby they are confident that they can do it, and maybe don't realize just how much work they need to put in, these are the people who are most prone to scams, and people who are most likely to end up losing their money and leave the industry with a really bad taste for trading. Which is why I think it's important that I include a section within this mini course, which is really an expose on the dark side of the industry, to make sure that no one falls prey to some of the scams and unethical business practices of individuals and companies on the dark side of the industry. And we're going to cover this in more detail in the next video.